Namaskar, friends. I am your stock market mentor, Mansi, and we are in for a wonderful trading strategy. Imagine for a moment, you enter a room. Seated around a large wooden table are six of the greatest traders who ever lived. Jesse Livermore, William O'Neill, Stan Weinstein, Nicholas Darvas, Mark Minervini, and Paul Tudor Jones. Each one has made fortunes in the stock market. Each one has survived crashes, bear markets, bubbles, and panic. Now imagine I ask them one question. If an ordinary trader could trade only one swing trading strategy for the rest of his life, what would that strategy be? Would they recommend complicated indicators? Would they recommend predicting the economy? Would they recommend buying cheap stocks? Surprisingly, the answer would be no. Today we are going to discover the strategy that captures the combined wisdom of these trading legends. And by the end of this podcast, you will understand a complete framework that can potentially transform the way you trade. So let's begin. Before we discuss the strategy, let's discuss the biggest mistake most traders make. Imagine a farmer. Every week he uproots his crops to check whether they are growing. What happens? The crop never grows. This is exactly how many traders behave. They buy random stocks. They chase tips. They jump from one strategy to another. They buy weakness. They panic during corrections. They book profits too early, and then they wonder why consistent success remains elusive. The legends understood something profound. The market rewards patience, preparation, and discipline. I repeat, the market rewards patience, preparation, and discipline. Once again, the market rewards patience, preparation, and discipline. Not excitement, not predictions, not gambling. Let's begin with Jesse Livermore. Perhaps the most famous trader in history, Livermore repeatedly emphasized one principle: the trend is your friend. He observed that the strongest stocks tend to become stronger, the weakest stocks tend to become weaker. He never wanted to fight the market. He wanted to move with it. Imagine swimming in a river. You can swim against the current, or you can swim with the current. Which is easier? The stock market works exactly the same way. The first lesson from Livermore: trade in the direction of strength. Now William O'Neill enters the discussion, the creator of Can Slim. O'Neill studied thousands of stock market winners. Do you know what he discovered? The biggest winners were rarely cheap. They were often trading near their 52-week highs. This sounds counterintuitive. Most people look for bargains. O'Neill looked for leadership. Because winners continue winning. Leaders continue leading. When a stock is making new highs, it is often telling us something important. Institutions are accumulating. Mutual funds are buying. Large investors are building positions. The market is voting in favor of that company. O'Neill's lesson: buy strength, not weakness. I repeat, buy strength, not weakness. Once again, buy strength, not weakness. Stan Weinstein simplified markets into 4 stages. Stage 1, base building. Stage 2, uptrend. Stage 3, distribution. Stage 4, downtrend. The greatest profits are made during Stage 2. This is where institutions are accumulating shares. This is where trends develop. This is where major moves begin. Many traders accidentally buy in Stage 4, then wonder why their stocks keep falling. Weinstein would say, don't buy everything. Buy only Stage 2 stocks, that is, the stocks which are in uptrend. I repeat, buy only Stage 2 stocks, that is, the stocks which are in uptrend. Now let us combine these ideas. Before considering a stock, check: is price above 50 DMA? Is 50 DMA above 150 DMA? Is 150 DMA above 200 DMA? Is the stock near a 52-week high? Is it outperforming Nifty? If the answer is yes, the stock has passed the trend template. This immediately eliminates hundreds of weak stocks. You focus only on the strongest candidates. Think of it as selecting Olympic athletes. You don't start with average performers. You start with the strongest. I repeat, you don't start with average performers. You start with the strongest. Once again, you don't start with average performers. You start with the strongest. Now Nicholas Darvas. Nicholas Darvas was a dancer, not a financial analyst. not an economist. Yet he made millions. How? He discovered something remarkable. Strong stocks move, then pause, then move again. I repeat, strong stocks move, then pause, then move again. Once again, strong stocks move, then pause, then move again. He called these pauses Darvas boxes. Imagine a rocket. Can a rocket travel continuously without pauses? No, it needs phases. Stocks behave similarly. A stock may rise from RASN 100 to RASN 40, then spend weeks moving sideways. This is not weakness. This is preparation. Energy is building. The next move is being prepared. Now we arrive at the most important concept, the volatility contraction pattern, or VCP. This is where Mark Minervini revolutionized modern swing trading. Imagine a crowd leaving a stadium. Initially there is chaos, noise, movement, confusion. Slowly the crowd thins. Eventually only a few people remain. The same thing happens inside a stock. During consolidation, price swings become smaller, volume becomes lower, volatility contracts, weak holders exit, impatient traders leave, only strong hands remain. This creates explosive potential. Minervini called this volatility contraction, and it often precedes major breakouts. Now comes the moment every trader waits for, the breakout. Suppose resistance is at rupees 150. The stock has spent weeks preparing. Volume has dried up. Volatility has contracted. Suddenly, the stock closes above rupees 150. Volume explodes. Institutions rush in. Demand overwhelms supply. This is your signal. Not before, not based on hope, not based on prediction, based on evidence. Buy the breakout. Let the market prove itself first. Paul Tudor Jones once said, "The most important rule of trading is great defense." I repeat, the most important rule of trading is great defense. Once again, the most important rule of trading is great defense. Most traders focus on profits. Professionals focus on survival. Survive, survive, survive. Because survival creates opportunity. This brings us to stop losses. Suppose, entry at rupees 150. Stop is at rupees 142. Maximum risk is rupees 8. Before entering, know exactly where you will exit if wrong. The market does not care about our opinions. The market only rewards discipline. I repeat, the market only rewards discipline. Once again, the market only rewards discipline. Now comes the difference between amateurs and professionals. Position sizing. Suppose you have rupees 10 lakh. You decide, I will never risk more than 1%. Maximum loss allowed. Rupees 10,000. Risk per share, rupees 8. Position size, rupees 10,000 divided by rupees 8. Approximately 1250 shares. Notice something. Risk was determined first. Profit comes later. Most traders do the opposite. Professionals start with risk. Now comes the hardest part, waiting. Waiting is not easy. Livermore famously said, "The big money is not in the buying or selling. The big money is in the waiting." Most traders can buy. Most traders can sell. Very few can hold. Imagine planting a mango tree. Would you dig it up after 2 weeks? Of course not. Great stocks need time. 20%, 50%, 100%. Sometimes more. The wealth is created by sitting patiently with exceptional winners. I repeat, the wealth is created by sitting patiently with exceptional winners. Once again, the wealth is created by sitting patiently with exceptional winners. The complete checklist. Before every trade, ask, is it above 200 DMA? Is it near a 52-week high? Is it in a strong sector? Has it formed a tight base? Has volume contracted? Is there a breakout with strong volume? Do I have at least a 1:3 reward to risk ratio? If any answer is no, skip the trade. Remember, you don't need many trades, you need good trades. I repeat, you don't need many trades, you need good trades. Once again, you don't need many trades, you need good trades. Final message. If Livermore, O'Neill, Weinstein, Darvas, Minervini, and Paul Tudor Jones sat together and designed one strategy, it would likely look remarkably similar to this. Find strong stocks, wait patiently, allow volatility to contract, buy the breakout, control risk ruthlessly. Let winners run. Simple, elegant, powerful. The market rewards those who can combine patience with discipline. And perhaps the greatest secret of all, success in trading is not about predicting the future. It is about positioning yourself when probability shifts in your favor. Thank you for joining me today. This is Monsi, wishing you disciplined trading, intelligent risk management, and long-term success in the markets. See you in the next podcast. Bye-bye.